The reality is that you're going to exit your business someday. Just accept it.
Welcome to the final chapter of The Game Changers.
You're going to die. You're going to get old. Half of you are going to get divorced. Probably more than that are going to have a falling out with your business partner. You're an entrepreneur. You get bored, you get itchy, you need to move on.
Meet Joe Valley, the master of acquisitions and the best-selling author of the EXITPreneur's Playbook. Joe was involved in the transaction of $100 million worth of exits, and he's had conversations with over 8,000 entrepreneurs over the last 9 years, and he's still counting.
So you have two choices. You can exit it at a great price to a great buyer with great deal terms, or you can let it slowly die in the vine and close the door, throw away the key and walk away. If you built it for years, you've been working on it for years, there's value in it, and you should understand the value of it so that you can walk away when you want to.
Joe is a broker at Quiet Light who mediated several famous WordPress acquisitions, including sales for Syed Balkhi and the sale of Imagely in 2020. Joe is here to talk about business. And if you're here watching this instead of going to business school, you're in good company, because that's exactly what Joe did too.
I didn't go to school to become an M&A advisor. I didn't go to Harvard and go to work at an investment banking firm. Instead, I took the entrepreneurial route. I've built, bought, and sold a total of 6 of my own, and currently have 2 additional companies that I haven't sold.
In today's video, Joe is going to share everything he's learned about exits for WordPress plugins. But the story of this call didn't actually start with Joe at all. Early in 2021, I reached out to my friend Diego Imbriani. I had tons of questions about the businesses he's bought and sold over the years as a solo WordPress developer.
My first sale of a plugin business was, I guess, about in 2015. The plugin was modular.
I wanted to know how Diego navigated his acquisitions, from finding the right buyer to getting the right value.
The business was sold for $9,500, which I guess is, for sure is too low.
And it was from this meeting with Diego that I gained my first valuable bit of insight into the WordPress market. So how did you manage your evaluation process?
I didn't know how to evaluate the price properly. And I also felt like I was kind of in a rush. I wanted to not to miss the opportunity to sell the plugin. So after a couple of days after last proposal, I accepted the highest price, and I sold it for that price.
And this story of Diego's first sale is extremely common when it comes to our market. Because naturally, as a solopreneur with training in software, the chances of you knowing just what to do when it comes to selling your business is rather slim. And what's the best piece of advice you can offer developers following your experience?
Don't believe buyers who tell that if you don't close the deal within few hours or one day, they won't buy the product, because it's simply not true. It's just a way to make you under pressure.
My call with Diego inspired me to reach out to some of the biggest acquirers in our industry, aiming to get some answers. And over the last few months, I've released an episode for each of these conversations. But while I've gained a whole lot of knowledge talking to these amazing business-oriented people, one big question remains unresolved. How can a software-oriented solopreneur like Diego go through an acquisition process and make the best business-oriented decisions without a significant background in business? Would you recommend collaborating with a broker to handle the pressures of going through an acquisition?
I think sellers think that the broker is going to help solve the problem. I think what ends up happening is the broker doesn't know your business as well.
In most of the calls I've had with acquirers who are WordPress insiders, the idea of working with a broker was not warmly welcomed.
All of the brokers that I've spoken to and that have given me offers of representing me, in my mind, did shit. They do nothing. They don't guarantee anything. they just take a certain percentage.
I think where brokers can be helpful is if you are looking for a financial buyer. A financial buyer being someone who just wants to own a good business. They want to own something that is, generating some cash flow today. They believe that over the coming years it will increase, and they can either hold it indefinitely or potentially sell it later for a good return.
You're going to be left with buyers who don't understand the WordPress ecosystem as much, and you'll find that certain buyers, you might think of them as intelligent buyers, in the space will bow out.
The common opinion in the WordPress community is that, if you're a financially driven seller, go to a broker, max your exit value, fine. But if you're really looking for a buyer to care for your product, care for your roadmap, care for your users, you should really look inside the WordPress community at buyers who are familiar with WordPress. What do you have to say to that?
If you're a WordPress developer and you have the mindset that you want to just sell to a WordPress developer because they're the only ones that are going to take care of your customers, I would disagree. I would disagree completely, because the people that are, buying an online business through an advisory firm like QuietLight are making investments to protect their money and get a positive return on their investment. They're mature enough and smart enough to know that the way to do that is not to break or try to fix what's not broken, right? My father always used to say, don't fix it if it ain't broken. The buyers look at it the same way. They want to protect the existing customer base and grow it. They want to take care of it. They want to protect their investment and maybe someday exit.
And Joe isn't just painting a pretty picture to get you on his side. He has proof from several well-known WordPress acquisitions that he has personally orchestrated.
Nathan Singh was never in the WordPress space. Syed sold to him. That plugin business is growing, doing really well. He cares about the customers. He cares about the staff. He's taking good care of them. Should Syed have sold for less to somebody else that was a developer? I totally disagree.
But doesn't your being a financially driven player impact the deal for the worse in any way?
The idea that, brokers are just going to find, money hungry, people that are just salesmen that are trying to, make more money and not care about the customer. That's how you make more money, by taking care of the customer, by taking care of the users. You care about it. You've got to do that in order to make more money in the long run. So these people are already fairly savvy. They're already fairly successful, and they understand that, and they're going to take care of your customer because they want to protect their business. I don't want to just get to my hooks into you for a commission, right? That's the perception of what brokers do, but it's not what we do. It's not what the best people do. They help first. They want to help you achieve your goals. And in turn, in the long run, it benefits them and their business as well.
Okay, so say someone in the WordPress space already wants to buy my business. Should I, drop that and go look for a broker and initiate a deal, through a broker anyway? Or should I just go with that buyer?
If you feel like you have a strategic buyer for your business, my advice would be go for it. Have a conversation with them. See if you can work out an arrangement that's going to be satisfactory to both of you. Based upon experience, the odds of that happening are fairly low.
Why is that?
All of the stars have to be aligned. They have to, be in the right frame of mind to buy instead of expanding and taking care of their own business. They have to have the money that's going to work for you. And just because they may be larger than you doesn't mean they have the cash sitting around, or, that they set up financing in advance, then an opportunity may come along. It's what they should do, but most people don't do that.
And what happens when you meet someone from the WordPress space who prioritizes selling to a WordPress developer? I'm sure there's, some people out there who see that as a priority.
My advice is always, when you've got a strategic buyer that you want to sell to and you want to do that on your own, I would help you and guide you and give you some nuggets all along the way, and go for it. But most of the time, you want to create a competitive environment.
But say I'm invested in this relationship with a potential buyer. We've known each other for several years. They've been following my progress. I know their priorities. They know my roadmap. What would be the downsides of just following through with them?
Let's say you've built a business and you want to present your brand to the sharks. You get ready, you work on your pitch, and then you go in and you show up and you walk into that room and 3 sharks call in sick and only Mr. Wonderful sitting there. You know you're not going to get as good of a deal. In fact, you're probably going to get a royalty payment deal from him. That's the same thing when you've got a relationship with a strategic buyer, or you think that that buyer is the best buyer for your business. There's no competition. When you create competition among buyers, you get a buyer that's willing to pay more and give you a better deal structure, and it's better for you too.
Getting advice on should you or shouldn't you work with a broker gets pretty tricky. Whether you're asking a first-class broker like Joe or a major WordPress acquirer like the ones we've interviewed on this series so far. Each of them have their own interests.
Now, again, I'm on the buyer side, so just to be clear, I understand the desire to move to a broker. I think what ends up happening is it makes things more complicated. So I don't know that that's in the seller's best interest, but I'm biased.
But this doesn't mean that going through a broker is necessarily bad for you as a seller.
Bankers know everything. I don't know how they know everything, but they always know how much money that deal was and that deal. And they are also the chattiest people among themselves or something. So they know, I don't know how, but they just know how much money other plugins have made. And that makes it easier to see, oh, this is a good bid or this isn't.
On my call with Marieke van der Ach, the former CEO of Yoast, the woman behind one of our market's biggest acquisitions, she said working with a banker, which is like a broker for larger deals, was an obvious choice. When you talk about interested buyers, how do you get those?
Our banker got those. So the banker knows everybody and they started talking, and then you do talks with all kinds of companies and with private equity parties. So they're not names that you would know because they're not in the WordPress world. And they just say, well, if you're interested, you have to do like an initial bid before the end of, I don't know what it was, May or something. And then they'll give the first bid, and then we can talk for another time. And at the end, the one that's most interested in us and which we felt most comfortable with ended up being Newfold Digital, who bought us.
And this is how all the bigger companies are doing it. So wait a minute, you say you literally spoken to 8,000 entrepreneurs in the last 9 years?
Oh yeah, that's actually probably a conservative number, to be honest with you.
And how many of those actually ended up turning into a deal?
If you figure I've closed about 100 million in transactions at $1 million per transaction on average, it's only 100. So thousands and thousands of conversations that are light in nature, some deeper. Too many people drinking through a fire hose and too many people not taking action on the advice it's giving them. So a very small amount.
And when a company approaches you, how do you decide if you want to work with them or not?
Well, first we have to like them, right? Is that too real for you? I mean, they have to be good people. They have to be honest and trustworthy. It has to be a good business. But we go through an entire process, an interview process with them. We can call it a discovery call, if you will. First, helping to determine if their goals are realistic and if they have goals, first and foremost.
And at what point will you say, hey, here's a good fit?
So we're not actually determining whether or not we're selling their business for them now, because that's really not what they're looking for initially, at least most of the time. We're trying to help them understand the value of what they have and how to set exit goals that are realistic, and then reverse engineer a path to them. So if someone comes to us and says, I want to sell my business for $10 million and I'm currently doing $100,000 a year in revenue. Okay, that's a stretch goal, a very big stretch goal. And they're doing $100,000 a year in revenue and the business is 5 years old. Well, their goal is a little unrealistic, but we'll walk through the process with anyone and everyone, first making sure that their goal is realistic.
What is a realistic goal? And is there a barrier for entry? Will you take any deal of any size?
At Quiet Light, the minimum transaction that we want to take on is $250,000. And, so that means that you're going to be doing $75,000 in discretionary earnings, ballpark, to get started.
Most people watching this are software developers, not finance experts. So let's break down the jargon. What is seller's discretionary earnings?
These are the basic things. Look, I fell asleep in accounting class. Literally, honestly, head on the desk, fell asleep in accounting class in college. And I went to Northeastern University in Boston, Massachusetts, and it was a big school with like 200 kids in it. They all marched out. The other 200 marched in, and I'm sitting there drooling on the desk. But you got to get the basics down.
So what's a good financial 101 for people doing their own finances? Joe recommends using an accounting platform like QuickBooks or Xero to help you manage your financial books.
So the first thing is getting your numbers right. Accrual accounting, Syed, Eric, perfect the way they did these. When you run a profit and loss statement in QuickBooks or Xero, on the bottom row, it's going to say net income. That is not seller's discretionary earnings. Okay. Because if you, Z, are running your business and you're doing $500,000 in, let's say $250,000 in net income, right? So you run the P&L, at bottom line is $250,000, but you also pay yourself a salary of $250,000. It's an expense above that net income line. That salary is considered it's called something, an owner benefit is what it's called, right? You're benefiting from it. So that's called an add back. So you take that net income plus add backs equals seller's discretionary earnings. So you get that 250. If you were to sell your business on net income, you'd sell that for, let's say, $1 million, right? It's called a 4-time multiple. The reality is that in this case, very simplified, you add back that 250. Now your seller's discretionary earnings is 500. You got 250 on the net, 250 on the add back, 500,000. Your business is actually worth $2 million.
Another crucial financial metric is whether you run your business through accrual or cash accounting. If you run on cash-based accounting, your income will be documented when you actually get paid, even if it's 60 or 90 days after the deal was closed. However, when you do accrual accounting, the income is documented the very moment the deal is closed and you send an invoice, even if you don't immediately get paid. Why is this important? Because when you're preparing for an exit, you'll typically try to drive your revenue up towards the deal closing. You're doing this because you want to get better valuation, and if you do much better this month than you did last month, you want that growth to play a role in your exit valuation.
If this revenue that you generated this month is 10% or 20 or 30% higher than the same month last year, you're not showing that year-over-year growth for 60 to 90 days. If you sell your business next month, you're not capturing that growth that you have in the business in your profit and loss statement if you're doing cash accounting. So if you're doing cash accounting and you're selling your business, you're losing value because you're not showing the growth that you have.
What is the typical business size you process?
As this industry matures, our listing size matures as well. Larger listings bring on larger listings. 5 years ago, we hadn't sold one for $10 million. And then I sold a WordPress site for $9 million. And that brought on larger listings. Last year, we sold two of them for 25, and now they're getting larger and larger. But it doesn't displace the $250,000 listings or $500,000 or $1 million listings. Don't be ashamed of the size of your business. Is really the basic fact. If you've got a business that you launched and is profitable, you should be proud of yourself and excited by the future. If you're doing $250,000 in revenue and $75,000 or $100,000 in profit, fantastic. Reach out to an advisor, get a valuation so you understand the value of your business today, and that way you can reverse engineer a path to that exit goal. But if you don't get a firm valuation, you're just sort of letting the winds push you in the direction that the wind is blowing. You're not tacking back and forth and making sure you're on track.
What else do I need to know before I'm ready to sell?
If you want to sell your business and you're a developer, how much do you want to sell it for? These are basic things, right? How much do you want to sell it for? Pick a realistic number that would make you and your family comfortable, at least during the process of building your next business. Most people we work with are not selling their business and then never working again. They're relatively young because of the world we live in, right?
Yeah, so you say, first ask myself what I want to sell it for before I even know what it's worth?
So set an exit goal. And then what you need to do is to figure out what your business is worth today, right? You may have a goal, but if you don't know what your business is worth today, you can't chart a direct path towards that goal. You don't know how close or how far you are from it in terms of dollars and in terms of months or years. So you need to get a valuation.
How do I do that?
This is where the art part comes in. What you need to do to improve the business to make sure that it's going to be attractive to buyers in terms of growth, in terms of risk, in terms of transferability, in terms of documentation. The valuation process of a business is, I would say, it's 10% math, 90% art. And that's where we've got to really understand your business and the risks that it has versus the benefits that it has for buyers to pick the path that you would go on to improve it and shore it up.
How are WordPress exits valued compared to other businesses that you deal with?
WordPress plugin theme sites, historically, the ones that we've transacted have been at a higher multiple than the typical physical product e-commerce business. Then up from there is content. And then up from there is SaaS. But all of those can intermix depending upon the nuances of the business itself. But a solid content business that has good documentation in terms of the financials and SOPs and things of that nature, that's fully transferable, that has good growth and is not one channel risk and falling apart kind of thing, is probably going to be somewhere in the, I'm going to give you a broad range of 3.5 to 4.5 times. So if you're doing 100,000 in discretionary earnings, you're 350 to 450. If you're doing $1 million, 3.5 to 4.5. Caveat is that no two businesses are alike. And just because I said that doesn't mean you're in that range. Your business could be incredible and be at 5 or 6 times, or it could be struggling and be at 2 or 2.5 times.
Right.
It's an important thing to understand, and it's an important thing to consider when you talk about the multiple, that the money you're getting from the sale of your business is taxed quite differently than from the ordinary income that you're paying, ordinary income taxes. So you're going to be taxed at a lower rate, capital gains taxes versus personal income. So when you do the math on what's left over after taxes, it's not the 35 or 45% you may be paying as an entrepreneur if you've got decent income in the $300,000, $400,000, $500,000 range. It's going to be at a lower rate, at least for now in the US, and that can change with administrations, of course.
And how does it impact the valuation of the business when a business implements subscriptions, annually, monthly, as opposed to one-off sales?
Subscription-based businesses are more valuable, simply put, right? So if I'm a buyer and there is a base of recurring revenue that continues to grow every month, why wouldn't I want that over the one-off sale and the one-off sale and the one-off sale? So if you've got the opportunity to build a subscription business, you want to do that because it's going to bring more value when you eventually exit your business. The key thing, I think, would be that you don't ever do lifetime subscriptions because that does no good to your future business. You get the money and then they have to service that client forever. So skip the lifetime subscriptions. And if you can, do monthly subscriptions, not quarterly or annual. Because if you do an annual subscription, there's a lot of math. You're getting paid for that customer today. You have to service them for the next 12 months. But if you sell the business next month, I have to service the customer for the next 11 months. And that means I want 11/12 of the revenue that you were paid last month. So keep it simple and don't do lifetime subscriptions. And when you do them, do it on a monthly basis.
And what typically happens when the product, the company has a team and founder on board? Will buyers be interested in deals where the team and founder are acquired along with the product? Or will most of your buyers be interested in asset deals only?
Most transactions are asset sales. They're not stock sales. And if there's a team in place that is remote, then it's great if that team goes along with the sale. The buyer doesn't want to mix things up, for the most part, and bring on, an entirely new team. Unless they've got a team that's already in place working on the same exact things, that would be a strategic buyer, not a general buyer. More often than not, the team transfers with the sale. And 99 out of 100 times, the founder of the business is selling because they want to move on, not because they want a boss. So when they sell, they're there for that short training and transition period, and then they move on.
And are deals typically 100% cash up front, or are there other structures that you see?
Deal structures are, the vast majority of them are cash. The larger the transaction, the more likely you're going to have some sort of seller note. Earnouts are a term that a lot of people throw around. Generally speaking, earnouts are reserved for businesses that are in trouble and there's a lot of risk. And so you're going to get paid as the business earns, or you've got the business based on future earnings and you're looking for a value that is much greater than it's actually worth today. It's very rare that a buyer would do that. But if they did that, then it's a business that has incredible growth and incredible success and incredible opportunities, and you're going to get an earnout. But generally speaking, it's going to be the vast majority of the deals are cash. If there's any kind of financing or earnout or anything like that, it's going to be 10 to 20%.
And once I have all my numbers sorted out, what else do I need to prepare?
First and foremost, I would say that if you're the developer and you have special non-transferable skills, that you need to outsource those. Because if someone's going to buy it and be an owner operator like you are, and they don't have those skills, they need to go and hire out to have somebody do the work that you're doing. And the key is non-transferable skills. If what you have in your head is easily, put down in documents and SOPs, and you can train a novice like me on how to do it, then it is transferable skill. But if it's years of experience that you have doing what you do, and the average Joe is not going to be able to pick it up in a short period of time, you should outsource that.
And once the deal is out, how many offers do you want to get?
You want more than one, but when you get to a situation where you get 20 offers, the next offer that comes in, the 21st offer, is probably not going to be incrementally different than the first 20. So, I think anywhere between 5 and 10 offers in a competitive environment. Year to date in 2021, we've had an average of 4.5 offers on every business. Okay. And that's comfortable. That's nice. And it's because of the environment we're in. If you get one offer, you're still in a good situation. You may have a great buyer at a great price, a great deal structure. But if you're in a situation where you can get multiple offers, you can, let them all know they need to come with their best and final. And it's not just about dollars. It's also about deal structure.
How long does it typically take to sell a company?
The average transaction from the time it's listed for sale to the time it closes is generally about 90 days. It takes about 30 to 45 days to go under LOI, 30 to 45 days to close. And then there's generally a short training and transition period afterwards. It's typically up to 40 hours over the first 90 days after closing.
Will it ever do any damage to a business owner if their deal fails to close?
The fear that your business is going to fall apart under letter of intent in due diligence and not close is one that is minor, right? You should be as fearful as getting struck by lightning, because I think that's how often it happens. If you do the proper work up front, right? We have a phrase here that it's get ugly fast, right? It means that if there are warts in your business, then we need to expose them up front before going under letter of intent. Otherwise, it's going to look like you were hiding the ugly facts about your business. They're going to be discovered in due diligence. Your buyer is not going to trust you anymore, and they're going to make an emotional decision to renegotiate or walk away. When you get ugly fast and you put together a full package on your business with lots of Q&As, the great, the good, the ugly, the buyer is going to go under letter of intent with a full understanding of your business. In due diligence, it's not emotional now. It's math and it's logic. And if your numbers turn out to be off by $5,000, it's math and it's logic. Sometimes it happens with exchange rates or things of this nature, a keystroke. So you just take your multiple of 4 times 5,000, there's a discount or an adjustment, I would say, of $20,000. The vast majority, literally 99% of the transactions that we work with, and I can't speak for others or when somebody's selling on their own, but they go from letter of intent all the way through due diligence and closing because of the amount of work that's done up front to build trust with the buyer and put together a great package to go under a letter of intent with.
What are the most common mistakes you see sellers making in the acquisition process? Are there any big mistakes you should avoid when working with a broker?
Yeah, I'd say the most common mistake if you're reaching out to an advisor or a broker to get a valuation, sell your business, is that you're agreeing to work with them in the first 60 minutes. And that you are, at the end of the call, they're saying, okay, I'm going to send you an engagement letter and you're going to sign that engagement letter. The reality is they can't learn enough about your business in 60 minutes to give you a true valuation. It's a process. It's not a pitch. They should be there to help and advise you first and foremost, and educate you through asking questions and learning about your business. But if you sign an engagement letter in the first call, I had a situation, last year, I talk about in the book actually, where someone came to me and had a phone call, was about to sign an engagement letter, and then felt a little uncomfortable about it, right? They were given a high valuation. They were dazzled with the numbers, and it was like, your business is worth $10 million. We've got multiple buyers for that. In fact, we just sold a business and we had 10 offers. And so there's 9 buyers that are a perfect fit for your business. This is worth $10 million. Here's the engagement letter. That's a pitch, right? You should know it. If it feels like a pitch, if it feels like it's too good to be true, it is. So this person came to me and said, I've got the engagement letter. There's something funny here. I'm not comfortable. So he went through the process with me. The reality of the value of that business, it was worth about $4 million because his financials were all wrong. The other brokerage firm was just giving him a value firm with an engagement letter based upon the conversation. You cannot value a business based upon a conversation. You give a broad range, but you have to firm it up. So if you are signing an engagement letter after one phone call, then that's a problem in my view. It needs to be a process. It needs to be an understanding of it. Because look, I don't want to waste my time with you if your business is, not sellable. I want to invest time early on to understand your business and understand the true value of it and share that with you and educate you so that we're both on the same page.
Second tip?
And you don't know when you're going to be ready. You're going to set that exit goal in dollars and reverse engineer a path to it, but you may be emotionally toast done before you hit that and you need to readjust it. Or you may get there and say, you know what? I've learned so much. I'm having more fun. I'm going to push that goalpost down the field a little bit. So you always want to be in a position where you can make that decision in an instant, if that's the case, or, know that you're approaching it in 6 to 12 or 24 months and track towards that.
Third,
before you reach out to an advisor for advice, what you should know and understand is that it's your business and you get to make the decisions at the end of the day. You want to have that call so that you can learn and understand the value of your business and what brings and plummets value, but it's your decision at the end of the day. You should not be talked into anything. And you should absolutely have a conversation with more than one brokerage firm. Not everyone's going to like Joe Valley or Chuck Mullins or Amanda Rabb here on the team. They may want to work with somebody else on the team, or they may just connect with somebody at FE International or Website Closers or Empire Flippers or one of the competitors that are popping up. It's your business and the relationship is very personal, right? Your advisor, your broker is going to be helping you sell what is likely your greatest asset. You need to make sure that you have a good relationship with them and connect with them, because I promise you, it's going to get emotional when you're 3 days away or a week away from $1 million, $500,000, $5 million. It's going to get emotional. The best advisors are, yes, they're great at all the numbers and the analysis and the valuation, but what they do really, really well is manage your expectations and your emotions so that we get all the way through to closing without hiccups. Well, hiccups that are permanent and derail it. There's always hiccups.
Any last bit of advice to conclude our call?
When it comes to selling, if the CEO of a Fortune 500 company wants to sell the business, are they going to do it on their own? No. They're really smart. They're really savvy, but they don't have this entrepreneurial, I got this mentality that I call an affliction, because I got this is a common phrase inside my house. And my wife is like, yeah, right. Let's just hire the carpenter. Let's just hire the expert. We think as entrepreneurs, we can do anything. CEOs of Fortune 500 companies know better. They're not entrepreneurs, right? They're, well-educated, highly paid, successful business managers. They don't got this. So I would think about that. The people that are much more successful and savvy than we are don't got this. So just because you're an entrepreneur doesn't mean you got this. So don't make that mistake.
For those of you following us, I hope you enjoyed looking at the WordPress ecosystem from a business-oriented point of view. And for those of you joining us for the first time, I'd recommend looking through the description below to see other titles that might be of interest, and subscribe for updates on future videos.